Good afternoon. Welcome. Uwe Jacobs, property strategist from Property Friends. I'm just getting here a fun message. Anyway, yeah, look, I hope this works. Who knows? Anyway, I think I'm live. Yeah, I think it'll be all good. Anyway, look, it's all good. Technology, it's often a challenge. All right. So the subject for today was the seesaw effect of rental yield and capital gains. Most people will tell you you can't have both, and I go bullocks. Just putting it out there, as I normally do. It is quite possible to have your cake and eat it too, and that is absolutely what is Property Friends' strategy. Let me explain. And by the way, we're still in ISO in Victoria, so I'm very casually dressed. Forgive me about that. It's not about the dress code, it's about the information. The information is good. So there you go. I talk about rental yield as the short-term money. The short-term money because the rental yield in a property needs to be high enough for us to be able to fully fund all costs, including 100% calculatory finance cost for the property. So what that means is that currently we need about 5%. Now, so the first gate that a property has to go through that we would even consider, it needs to be having a rental yield of 5%. Now, the second gate that it needs to go through is that there needs to be an expectation for capital gains. Now, capital gains is crystal ball gazing, very clearly. Nobody, in my view, can guarantee capital gains. All you can do is do the best research that you can do, look at it from all points of view, and then make an educated guess, an educated decision. The one thing that's better than that is to what I call manufacture capital gain. Case in point, we're doing a couple of deals in Cairns in Far North Queensland at the moment. We have done exactly that. I was able to find a block in Edmonton with a developer that has just sold the remainder of the development. Now, for starters, we are able to lock the block in at a pricing from 3 years. That developer never changes their prices, and that block bounced back due to a finance falling through. Cut a long story short, I saw it and grabbed it. Now, and remember, we don't buy and on sell, we just reserve things and then put it through to you. Anyway, so we've got a block that, in my view, again, educated guess, you do your own research, this is not financial advice, blah, 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 is $30,000 under the market. Now, we have planned a duplex on that block because it is an 813 square meter block where you've got an as of right to do a strata title. Again, I don't know about you, but a strata title, when put through, is an immediate uplift of about 30 to 50,000. Let's say 30. So now I've got 30 plus 30, so I'm sitting on $60,000, what I call manufactured equity. Now, if that ain't a 10% jump up front, and if that isn't advancing the situation to roll into the next one and or giving you security, I don't know what helps. And this is what is the trick in the whole game. The trick is to have the short-term money, which is the small money, which is funding us being able to sit and wait for the capital gain. So the rental income needs to be high enough that, heavens forbid, in the case of Sydney, if a city sits there for 7 years, no capital growth, I don't want to be in a situation where I've got to pay $500 a month in the hope that I get capital gain next month, next month, next month, next month, next month, next year, 5 years. Imagine that, paying $500 into an investment property because it's negative cash flow, negatively geared. You go crazy. That has a real impact into your lifestyle. That's why we say the short-term money, the rental income, needs to be high enough for the property to completely pay for itself. Then we look at the long-term money, and that's where the big money is. Even if I have, let's call it $300 a month in positive cash flow, which is not doing badly in my view, that's $3,600 a year. Call that times 5 years. That's, call it $16,000 in rental income over 5 years. You only need one good year of 10% and you've outperformed rental income in any event. Now, over 5 years, I certainly would expect to make more than the equivalent of 5% in capital gains. So there you have it. Short-term, long-term income. Rental yield is the short-term, it's a small income, but it's very necessary. Capital growth is a long-term income. That's where the big money is made. Any questions? Don't hesitate to book a discovery session on our website. At the bottom, scroll down, or at the top right, there's also a button. Up to 30 minutes, I'm happy to have a free chat and explain it more if you've got questions. All right, have a good day. Bye-bye.